Hey everybody, Smart Silver Stacker here. Today is Thursday, January 5th, 2023, and we are seeing a bit of a sell-off in the precious metals today. At the time I'm recording this video, the price of silver down a little over 2%, and the price of gold down just about 1%. Now, it's not just the precious metals. Markets across the board are selling off today. Now, what is causing this decline? Well, this is all occurring against a backdrop of a better than expected ADP jobs report. And this is just another example of this good news is bad news dynamic that we have been observing in these markets for some time. And it just shows you that fundamentals are not what is driving these markets. The only thing that matters right now is the anticipation of what the Fed is going to do next. Now, in today's video, we're going to delve into those job numbers a little bit more in depth, and I'm going to tell you why I don't believe that they are painting quite the rosy picture of the economy that many analysts seem to think. But also, we're going to talk about why I believe that this sell-off in the precious metals is really nothing more than a buying opportunity. So let's get to it. I do want to say a big thank you to all of you for tuning into today's video. If you enjoy it and you get some value from it, please do give it a big thumbs up down below. And while you're at it, why not subscribe to the channel? And today's video is brought to you by SD Bullion, my preferred gold and silver bullion dealer. Don't forget to check them out with the link down in the description. Okay, so we've got markets across the board selling off against the backdrop of this better than expected ADP jobs report. We've got the S&P 500 down, the Dow down, NASDAQ, all the major stock indexes falling today, as well as precious metals. So gold down a little over 1% at the time I'm recording this. Silver taking a bigger hit, down 2.6%. Now, nothing unusual about that. It's very typical to see on down days silver moving faster than gold. It's a smaller market, it's more volatile, so that is kind of to be expected. But the whole idea that markets are selling off on this ostensibly good news is just another indication of how broken the price setting mechanism in these markets really is, and how all that these markets are depending on at this point is the Federal Reserve. Now, let's take a look at this jobs report and delve into some of these numbers. Now, you can find this at adpemploymentreport.com. If you want to take a look at this yourself, you can see that in December, according to this report, the U.S. added 235,000 jobs among private employers. That was better than expected, and supposedly this is painting a pretty good picture for the U.S. economy. And the idea here is that if the economy is recovering, then that means there's less chance of the Fed actually pivoting or intervening in these markets. But let's delve into these numbers a little bit and let's see what kind of a picture this actually paints for the economy. So if we go down here, we can see that it breaks it down by sector. So natural resources and mining jobs falling by 14,000. So jobs that actually produce natural resources falling. Now, construction, this one was a bit strange to me. This is up 41,000 supposedly in December. And I do find that quite odd in light of the reports that we are seeing that higher mortgage rates are causing a decline in single-family housing starts and building permits. This is a report released on December 20th in Reuters. And so I don't know what exactly all the folks getting hired in these construction jobs are building, but nonetheless, we do see a gain there according to ADP. Manufacturing jobs, again, jobs that actually produce things which perhaps we could sell or consume domestically, falling by 5,000. Trade, transportation, and utilities declining by 24,000. IT jobs up by 1,000. Okay, that's fine. Financial activities falling. Now, here is where we really get into the bulk of the gains. Professional and business services, education and health services, and then leisure and hospitality. This is the lion's share of these job gains, coming in at 123,000 jobs added in the leisure and hospitality sector. Now, you notice that most of these jobs are all service sector related, and then leisure and hospitality specifically. I mean, let's face it, these are not great jobs. These are not high paying jobs. These are typically, waiter, waitress, bartender type jobs. So, you can earn a living doing that, but you're not adding particularly high quality jobs to the economy here. And also, these are not jobs that produce anything. I mean, they produce a service, making you a margarita, bringing you a cheeseburger, whatever, but they're not producing actual goods that go to the store and can be purchased. So in terms of inflation and actual economic growth and activity, this is not a particularly good jobs report if you ask me, especially when you look at it in light of everything that is going on in the economy at the moment. Because what I suspect is that these leisure and hospitality jobs that are being added, the 123,000 jobs, they're probably people looking for second jobs, just trying to make ends meet. I mean, look at some of the news that we got in December. The share of Americans living paycheck to paycheck at 63%. So very likely those are folks who have a primary job and they're going and waiting tables in the evening or taking a weekend job, that sort of thing to help make ends meet, because the American consumer is under so much pressure due to rising inflation and how bad the economy actually is. We've also seen credit card debt and interest rates both heading towards record highs, another sign of how stressed the American consumer really is and how bad the U.S. economy is. I mean, you might be adding jobs, but you are not adding savings, you're not adding real wealth. In fact, people are going into debt. And this is all very ominous as we head into 2023. It's very likely that we're going to be heading into a recession. I mean, very likely we already are in one, but there's not going to be any dispute of that as 2023 plays out, because things are not getting better, folks, regardless of how many waiters and bartenders are getting hired. Also, we've seen the personal savings rate decline to near record lows. This is a long-term chart provided by the St. Louis Fed, and you can see that there was this big spike up in 2020 when we had stimmy checks going out, but now we are down very low, so a very low savings rate. Americans are being forced to tap into their savings to help make ends meet. They're racking up credit card debt. And so when I see 123,000 service sector jobs in the leisure and hospitality sector, it doesn't make me feel like the economy is doing great. I don't know about you. Leave me a comment down below to let me know what you think. And also on this news, we have seen this sell-off in assets across the board, precious metals, stocks, all of these assets coming under some pressure here. Again, the reason being that the market no longer anticipates as much easing from the Fed. They think, oh, well, the economy's doing great. That means the Fed's not going to have to intervene. But I don't think that that's the real message we're getting from this jobs report at all. And the dollar rallying somewhat on this news, inverse to all of those assets selling off. But if you take a look at this chart of the US dollar index, it doesn't look too good for the dollar. I mean, this looks like perhaps a bounce off of some resistance around the 102 level. But you can see when the dollar broke down from its parabolic uptrend last year, towards the end of last year, basically when the Fed began to insinuate that they were going to be reducing the pace of their rate hikes, I don't think that we're going to be hitting new highs when you look at this chart. I think that this is just a little bit of a dead cat bounce in the dollar, and we will be resuming the move downward in short order. I mean, certainly the amount of dollars being created would indicate that. Just look at the amount of spending. Look at the U.S. deficit. I think we're at $1.4 trillion now in deficit spending for 2023, and that number likely to move much higher. So the U.S. dollar may be rallying a bit on this news. Assets may be selling off, but I view this really as just more of a buying opportunity in the precious metals, because ultimately I believe the Fed is going to be pivoting. That's why I'm going to continue stacking precious metals. I mean, I might go take a look at what SD Bullion has for sale today. Maybe I'll pick up some coins. I think they have a special on 2023 maple leaves. Thinking about getting some of those. That's going to be the last year. I think the Queen is going to be featured on those, so maybe they'll be a little bit collectible. But anyway, just want to point out that today's news of the ADP Jobs Report being better than expected, it's not really the rosy news that many analysts and many mainstream outlets are portraying it as. And when you delve deeper into those numbers, I think that that is kind of the picture that it paints, that things are not great here in the U.S. economy. Maybe people are getting second jobs, but that's not a sign of some kind of a vibrant economy. It's a sign of U.S. consumers that are being pushed to the brink and are really struggling to make ends meet as we enter into 2023 here. And I think that there is a very strong likelihood that we could be entering into a nasty recession, and you'll want to have some hard assets. I mean, it's not financial advice, of course. I'm not a financial advisor, but I view tangible hard assets like gold and silver as the place to be in the environment that we find ourselves in. Let me know what you think in the comments below. Let me know what you think about all the points I covered in today's video. And I do just want to say a big thank you to all of you watching. Stay safe and happy stacking, everyone. I'll catch you next time. Smart Silver Stacker out.